Hi guys, so I'm back. I'm gonna go through the straight line method of depreciation in this video, and so let's just hope this helps you guys because you're gonna have to do it for the exam on Monday. Okay, so let's go. We have here a machine costs $12,500. It will be kept for 4 years and then sold for an estimated figure of $5,120. Now this $5,120 is your disposal value. They're asking you to calculate the depreciation charge using the straight line method. So based on the information they give you, you have to use the formula. So what is the formula? Cost price minus disposal value all over number of years, okay, of use. So let's plug in the figures that we have here from the information above. The cost of the machine is $12,500. The disposal value is $5,120, and the number of years you're going to keep it is for 4 years. I'm now pulling out my calculator here, and we're going to get the depreciation charge every year being equal to $12,500 minus $5,120 equals $7,380 all over 4, and that will give us $1,845, right? $1,845. So I have a table here on the side that I'm going to use to show you how to work out the straight line method. Okay, so we starting with the cost price of the machine, and you're going to use the machine for a whole year, and at the end of the year you're going to depreciate it by the amount you used in the formula. So it's no longer going to be worth $12,500. You have to depreciate it at the end of the first year. The depreciation amount is $1,845. So it will be $12,500 minus $1,845, and at the end of the year the current value of the machine will now be $10,655. This is what you call the net book value, or the current value after you depreciate the machine. So the net book value at the end of the year 1 is now the current value at the start of year 2, right? Year 2. Now year 2 starts, the machine is worth $10,655, and the whole year goes again. You use the machine in the business, it's going to depreciate, it's going to break down, it's going to wear and tear. So at the end of the second year you have to depreciate that machine again. But because we are using the straight line method, it's a fixed depreciation charge every year. So you're going to depreciate it now at the end of the year. Depreciation charge at end year 2 now would be the same, $1,845. Cool? And now you're going to get a net book value at end of year 2. Right? So you're taking out the $10,655 minus the $1,845, and now the value of it at the end of the second year will be $8,810, which will also be the current value of the machine at the start of the next year, which is the third year. So the net book value of the end of year 2 is also the net book value, or the current value at the start of year 3. Okay, now of course you don't have to write in all of those little things in for me for the exam, but nonetheless, let's go. So year 3 is now starting, and we are going to use the machine again, and you're going to use the machine, and at the end of the third year you're going to charge the depreciation again at the end of the third year. So at the end of each year you're going to charge that $1,845. So we reach the end of year 3, 1845. You have to do this for 4 years, or however many years they give you in the exam. So it's 8,810 minus 1845, and the machine is now going to be worth $6,965. So this is now your current value at the end of year 3, or your net book value. In accounts, we don't say current value, we say net book value. That is the book value of the machine at the end of year 3 or at the start of year 4. So we are at net book value for the end of year 3. And we are now into year 4. We use the machine again, and again you're depreciating it at the end of year 4. We are using the straight line method. It's a fixed charge every year, so depreciation charge of the machine for year 4 will be again 1845. You're minusing it from the net book value to get you your net book value at the end of year 4. So it's net book value of end of year 4. So it's 6,965 minus 1845, and you will end up with $5,120. Does this look familiar? Yes, it does, because hey, look at that. The net book value at the end of year 4 is the scrap value or the disposal value that the examiner would have given you. So guess what? That's the end of the workings for the straight line method using the formula. Cool? Not too bad. Not too bad at all. So let's see if I can turn this. Well, you would have had an exercise in your workbook to do. Cool. Now, we have depreciation charges using the straight line method using a percentage. Now, let's see if I have time to do this in this video, because it's only 15 minutes I have. So I'm going to use this. It's not the formula. You're using it as a percentage of cost. You're going to calculate your depreciation charge as a percentage of cost. Now, you're not going to get this in the exam, right? But I'm still doing it now. The video is for 15 minutes, so let's go at it. Okay, so we have here the cost price of fixtures and fittings is $15,000. The fixtures and fittings will be held for 3 years, and you're using the straight line method using a percentage of 30%. That's cool. That's no problem at all. Okay? Now, it's straight line method. That means whatever you get in the first year will also be a depreciation charge for the second year, and it will also be a depreciation charge for the second year, and the depreciation charge for the third year, because you're keeping it for 3 years. All 3 years, the depreciation charge will be the same thing, 30% of the cost price. So when you work out 30 over 100 multiplied by 15,000, it works out to be 4,500. So the depreciation charge for each year, even though it's a percentage, it is going to be fixed for each year. Sorry to sound like if I'm buffing you, but I don't know how the audio is on this thing. First time I'm doing this here on this tablet. Okay, so let's go. Cost price of fixtures and fittings, 15,000. And again, you're going to use this fixtures for a year, and you're going to depreciate it at the end of the year. So we said it's 30% of the cost price, which is 4,500. When you take away the depreciation charge from the cost price, you're going to get net book value. So 15,000 minus 4,500 is going to give you 10,500. You're going to do the same thing for the other 2 years. So you reach the net book value at the end of year 1, which is also the net book value at the start of year 2. You're going to go through the whole of year 2, and then at the end of year 2, you're going to depreciate the fixtures and fittings. End of year 2. Remember, is going to be the same, 4,500. Take it away from the net book value at the end of the first year now. So it's 10,500 minus 4,500, and you're going to get 6,000 flat. So this is your current value of your fixtures and fittings at the end of year 2. Right? Net book value and year 2, which is also your net book value at the start of year 2. So we're going into start of year 3, sorry. So now we reach year 3, we're gonna now depreciate at the end of year 3. So same thing, because it's straight line, same amount, 4,500, fixed installment or straight line method. So this is now going to be depreciation charge at the end of year 3, 4,500. Okay, cool. So 6,000 minus 4,500 is 1,500. And we are going only up to the, how many years? 3 years. So this is the end of the workings for this question. If you, however, had to do it for 5 years, you would have continued this process for 5 years. So this 1,500 is your net book value of your fixtures and fittings at the end of year 3. And it's only for 3 years, so you can't go and depreciate the fixtures and fittings again. You don't even have 4,500 to depreciate again. The fixtures and fittings is now worth 1,500 at the end of 3rd year. So at this stage, the business can decide, hey, I'm going to keep it or sell it or scrap it. It's really up to them. But in terms of accounting records, this is all that you would need to do. Okay, so I'm going to end this video here, and I'm going to do the reduce and balance method on another video. Ciao.